CoreWeave has a $53.4 billion market cap, and they have $3.5 billion of revenue. They have been growing very fast. They're not profitable yet. Analysts think that it is a buy and it's discounted. The stock has been trading for less than a year. They IPO'd back in April and have really charged higher. They hit an all-time high of $183 a share back in June. Since then, the stock has settled down around $103 per share. The business is really booming. It's going really fast top line, which is pretty incredible. Their gross profit looks good as well, by the way. They have very good gross profit. The one area of concern is their balance sheet does carry quite a bit of debt. They have $14.5 billion of debt, while their cash is only $1.15 billion. Now, their debt to EBITDA ratio is well above the 3 that I like to see, which is quite high. If they keep growing really fast, I think they could grow to be so large that their debt to EBITDA will come down below 3 if they keep growing really fast. When we look at their forecast of revenue growth, it looks really, really incredible. They're growing at 180% in 2025, and then 126% in 26, 43% in 2027. And once they get to 2027, they expect to be profitable if you measure their earnings per share profitability. So that looks like a really bright future on earnings per share. On cash flow, they're not cash positive. And I actually put together a cash forecast using their gross margins as well as my expectation of when they'll be cash positive. I constructed a valuation for CoreWeave using their margins, when they're supposed to hit profitability. And I expect that maybe in late 2026, early 2027, they'll start producing free cash flow. And they're going to grow that free cash flow quite nicely by 50%. And in terminal value, they'll grow by 5%. And the intrinsic value of those cash flows is only 12.5 billion. So when we compare that, and plus I need to decrement the debt that they carry, which is a lot, the value of the company really isn't very high at all. In fact, I think you're dealing with about a 95% premium on the stock. A lot of that value goes away with the debt balance, and the cash flows just don't look that great just yet. So for now, this is just really, really priced high. Earnings per share look better, and I gave them a very preferential treatment here. I took their earnings per share that's 2 years away, combined it with next year just to kind of blend the 2 years. And even when I do that, give them that optimistic valuation, I'm still seeing a stock price that's 25% too high. So no matter how I see it, the CoreWeave business is really expensive, and it comes with added risks. The balance sheet, I hate seeing that number be eclipsed, the debt to EBITDA number. It's just when you study businesses that get in trouble, and it's debt. Debt is the number one problem.